Hi there. Everyone's got an opinion about where the housing market is heading in 2026. Crashes, booms, bubbles. But what if the truth is just a lot more stable and a lot less dramatic and even less interesting? Today, we're cutting through the noise to uncover what's actually happening right now. As a matter of fact, 2026 is already off to a very noteworthy start. In this in-depth video, I'll be covering prices, inventory shifts, new variables in the mortgage market, and signs that the market won't crash. Let's start with supply and demand, one of the most misunderstood data points. People keep saying that there are no buyers out there. And yes, demand isn't what it was during the COVID rush, yet demand is up. Mortgage purchase applications, a true measure of near future activity, have been trending upward for month over month and year over year for more than 6 months. Sales are down 53% from the post-pandemic peak and up 27% from just 3 years ago for local single-family homes. Supply has been historically low over the past 3 years. A big factor is that lock-in effect. Homeowners with 3% mortgages who have little incentive to move because their current payment is too good to give up. And did you know that 79% of home buyers are also home sellers? We're also seeing the inventory rise, bringing more options and more activity. That's a good thing. This is not 2008 all over again. Inventory is up 8 to 12% and down 85% from the 2008 peak. For a market crash, we need a lot more than that. Quick disclaimer, all of this data comes directly from the multiple listing service and reflects single-family homes in Bay Area. Another interesting headline from Redfin claims that this is the strongest buyer market on record. Well, their data only goes back to 2013, and for Silicon Valley, the market is actually quite healthy. I can confirm that these karma cycles are necessary to maintain that long-term appreciation after experiencing those wild 30 to 40 offers markets. So yeah, this has been a pretty balanced market overall, and it was pretty flat last year, and it's the best start to a year in quite a while. Pending weekly sales are at multi-year high. Purchase application data is at multi-year high, and price cut percentages are slowing year over year. The overall data curve began improving around mid-June last year, and that trend has continued. Of course, always keep in mind that we are in Silicon Valley, one of the nation's unicorn markets with significant regional variations. And remember, regardless of where you're located, certain homes will sit longer on the market due to specific factors like location, schools, size, and detractors such as power towers or busy streets. But the big question is, what's happening next? Since affordability is still tight and the lock-in effect remains strong, the market's going to continue to be influenced by interest rates. No surprise there, so let's break it down. There are 3 parts to affordability: home prices, which is steady, wages, which are increasing, and interest rates. That means that the biggest potential variable this year is mortgage rates. Rates started the year around 6.25%, briefly touched 5.99%, and they're currently hovering at just about 6.1%. That is a full percent lower than last year and 2 points down from 2 years ago, a 33% improvement. Are you waiting for a 3% mortgage? Fold that up, set it on fire, and throw it over your shoulder. We're probably never going to see that again. And if we do, refinance immediately. So, flat housing plus increasing wages plus lower rates equals small but real improvements in affordability. It's not huge, yet it's progress in the right direction. Keep an eye on mortgage-backed securities. If rates drop closer to 5.75%, expect a surge in activity, more competition, stronger pricing, and a renewed movement from lock-in sellers who finally see a gap enough to make that move, put their house on the market, and buy another at a reasonable rate. That would open up more entry-level homes and revitalize trade-up activity, while sideline buyers jump back in and chase the dangling carrot. So home sales should climb. The demand we saw increasing last fall will likely continue this spring. Now, what about all of those doom and gloomers? You have probably seen the headlines. Active foreclosures are up 20%. If that caught your attention, take a breath and look at the full picture. That increase reflects the lifting of a moratorium on FHA and VA loans, which is normal, and those numbers have already stabilized. Nationally, foreclosures remained 40% below pre-pandemic levels, and delinquencies are still trending downward. Also, less than 2% of all purchase loans in Santa Clara, San Mateo, and Alameda counties even fall into that category. Simply put, there is no forced selling. Affordability is improving gradually, and local homeowners are sitting on near record levels of equity. Our market remains one of the strongest in the nation from an equity standpoint. Last year, a lot of people focused on extremes. They stayed focused on data and trends, and once again, their approach paid off. Everyone's going to appreciate another normal housing market this year. In fact, housing affordability is now the best it's been in 4 years. A boring housing market is something we can all enjoy. Boring and normal build future appreciation. Just dig into the data, read and understand the details. It always beats relying on snippets and sound bites that lead to uninformed conclusions. So while others chase headlines, I'll keep chasing the data because boring makes often build the strongest wealth anyway. As always, I'm here to educate and navigate, not speculate and fabricate. Keep watching. The story of 2026 is just getting started. Thank you so much for watching and see you next time.